Hey, what's up, my friend? So, in today's training, right, I want to share with you 5 things you must look for before you place a breakout trade. Because here's the thing, right? I know that trading breakout can be exciting, right? The market breaks out higher and poof, right? Make instant profits, right? Ka-ching! But here's the thing, more often than not, you buy breakout, market reverse, and you get stopped out. And that sucks. Okay, so in today's training, right, I want to make it less sucky for you, right? To help you, avoid, right, getting caught in the false breakout. So I'm going to share with you the 5 things to look for before you place a breakout trade. Because if you often find yourself caught in the false breakout, your breakout always, hit your stop loss, isn't working for you, chances are you're not following one of these 5 things, right? So let's get started. Number 1. Before I trade breakout, the first thing I look for is for the market to be in a range of at least 80 candles or more. So why 80 candles? Okay, so now here's the thing, right? I put here 80 candles is just as a rough guideline, a benchmark. If on the chart it happens to be 78 candle range, right, I'm going to be perfectly fine with it. Okay, so I just put it 80 candles, so it's just something for you to recall easily. If you get like 77 candles, 79, it's fine. Don't sweat over it. Okay, and the reason I want this, right, is because based on my observation in the markets, okay, is that the longer a market ranges, the harder it tends to break. So if you observe a chart of maybe oil, gold, silver, whatsoever, if you see that it's in a long-term range, like for the last 5, 6, 7 months, chances are, right, when it breaks out, it's going to break out hard. So this is what we want, right, for our criteria when trading breakout. We want a market to be in a range because the longer it ranges, the harder it breaks. And why is that? So there are a couple of reasons for this. Stops triggered and breakout traders. Let me explain to you what this means. So let's say market is in a range, it goes up, down, up, down, up, down, up. What happens is that when the market is in a range, right, it will attract traders to trade the ends of the range. They will look to buy low, sell high, buy support, sell resistance. So if you think about this, right, let's say the market is at resistance now and it reversed down lower and you short this market. Maybe there's a shooting star pattern, maybe there's a bearish engulfing pattern, and you go short. Now let me ask you, where will you put your stop loss? If you're like most traders, I'm going to guess you put your stop loss above the highs of the range, maybe somewhere about here, above the highs of the range. And likewise, right, if the price comes down to the low of the range and it bounces up higher, you buy at support. I'm guessing you put your stop loss below the lows of the range. So you can imagine, right, as the market stays in a range, right, and more traders, look to buy support, more sell resistance, right, this cluster of stop loss will accumulate, right, more and more above the highs of the range and below the lows of support and below the lows of the range. And if you think about this, right, this cluster of stop loss, what do they represent? Okay, so let's talk about let's say a trader who is short, right? What does it represent? So a trader who is short the market at resistance, his stop loss, right, is pretty much a buy stop order. Because if you are short the market and you want to exit your short position, you need to hit the buy function, right, to get out of your short trade. Do you agree? So in essence, right, for a trader who is short, their stop loss, right, is in essence, right, a buy stop order. So a buy stop order is actually, right, a potential so-called energy in the market that could push the price up higher. Because if there's a lot of buy stop order above resistance, that's a cluster of potential energy that if the price, touches it, right, it could trigger, right, more buying pressure as short traders scramble to get out of their trade. Okay, so that's the first reason, right, stops triggered. The longer the market is in a range, more stops will be accumulated at the ends of the range, and if it's triggered, right, it could fuel, right, buying pressure, right, if the price breaks above resistance, and vice versa, right, could fuel selling pressure if the price breaks below support. Second thing, breakout traders. What's that about, right? So very simple, right? As the market is in a range, right, the longer it's in a range, the range will get more and more visible to the current time frame trader and the higher time frame trader. And there will be momentum trader, breakout traders looking to buy breakout, right? So they're just waiting for that signal, right? That confirmation as the price breaks above the highs of resistance, for example, to buy the breakout, right? And that again, right, would fuel further buying pressure. And this is why whenever I trade breakouts, I want the market to be in a range long enough, right? At least 80 candles, right, for me. Again, if it's 77, if it's 77.5, 78, it's fine. So let me just walk you through, what I'm looking for on a chart. So again, very simple. This is a very, very simple stuff that a 10-year-old can do it. So let's say you saw that the market is in a range between here and here. Okay, how do you know it has been 80 candles? Well, what you can do is calculate each bar one by one till the end of the range. So that is bar number 1, this is 2, this is 3, this is 4, this is 5. Okay, so you calculate until you have 80 candles. So that's kind of the old school way. I don't really recommend that. Alternatively, right, if you're using TradingView, you just pull out this ruler tool, press this at the start of the range all the way to the end of the range. Let's say this is the end of the range. Okay, and you see that right now we have about 80 candles for this example. This is about 80. Okay, that meets our criteria. We have at least 80 candles in this range. And let's say we try for, how about this, Bitcoin? Okay, same concept. Let's see, Bitcoin. Any range portion. Okay, so same thing, right? What about here? From the start to the end, right? Well, how many candles are there? So let's say this is the start of the range. Okay, and this is the towards the end of the range. We have about 89 bars over here, 89 candles over here. Simple stuff, right? So use that ruler tool, make your life easier. Okay? So thing number 2, what I look for? A build up. So what is a build up, Rayner? I don't get it, right? Do I build something up? No, not quite, right? So a build up is basically a tight consolidation. So this is a concept that I learned from a couple of traders. One of them is Mark Minervini. I learned it from Bob Volman as well. They use this concept. They may not use the word build up. I'm not sure if they did, but this is a concept that I learned from these two traders. So let me show you what is a build up. So pretty much market is in a range. It starts to consolidate. So this consolidation here is what I call a build up. Why are we looking for a build up? 2 reasons. Number 1, it's a sign of strength. Why do I say that? So imagine, right, the price is in a range. It goes up to resistance, comes down to support, up resistance, come down support, go up resistance. And then you know, right, that if the price is at resistance, this is where potential selling pressure should be lurking. This is where people want to sell at resistance. But if the price can still hold up at resistance, this tells you that, hey, you know, something is not quite right. It tells you that there is people willing to buy at resistance, even though the price is, you know, at this high. So that is a sign of strength. Okay? So again, another variation of a build-up could be something like an ascending triangle, where price make a series of higher highs and higher lows. This is another variation of a build-up as well, okay? So bear in mind. And the second reason why you are looking for a build-up is that the volatility cycle is in your favor. What do I mean by this? So here's the thing, right? Volatility of the markets, right? They are not static. The market moves from a period of low volatility to high volatility, etc. So for example, you know, market is not going anywhere, type volatility, then it breaks out, then volatility shrinks again, maybe collapse back lower, starts to consolidate and makes a huge spike in volatility, then starts to consolidate, you know, something like this. So you can see that market volatility, it's always changing from low to high and back to low to high, etc. So let me just show you a quick example. So if you look at Bitcoin, okay, same concept, right? Prior to this breakdown here over here, how's the volatility of this market? Well, it's getting quieter. Notice the range of the candles. So you can see that volatility, they moves in cycle. It's not always high volatility market condition forever. It's not always low volatility market condition forever. It's kind of like trends, right? They come and go. All right, so this is the key thing that we're looking for. Third thing, what do we look for? The 20 MA touches the build up. And that's because to me, it's a signal that the market is about to make a move. So here's the thing, right? So when I use this concept called the build up, right, one of the problems that I faced in my early years of trading is this, right? For example, the market consolidates and then it forms a build up. How many candles should a build up be? Right? That's a question that I keep asking to myself. Should it be 5 candles? Should it be 10 candles? You know, what's the right answer? So this is something that is very subjective because a lot of it depends on how long the range is. And it also depends, right, of the price action within the range. So that is something that I struggled for, you know, the longest time. You know, what's the solution, right? How do I know when the market is, you know, getting ready to break out? Because if you think about this, right, a build-up can be as little as 3 or 4 candles. Or maybe 10 or 20 candles. So when do we know it's the right time? So one objective way that I've used to define, right, when the market is getting ready to make a move is to let the 20 MA be your guide. The 20-day moving average or the 20, whatever time frame you're using, right, moving average to be your guide, right? You want to make sure that the 20 MA has caught up with the build up, right, before you trade the breakout. So just to explain what this means, if you look at this this over here, okay, you can see that we have this build up over here formed on New Zealand yen, right, within this range. But how do you know when is the right time to buy the breakout of these highs? Well, this is where the 20 MA can be your guide. Just put in the 20 MA. Notice, right, that the 20 MA has caught up with the lows of the build up, or rather it's caught up with the build up. Notice the 20 MA has touched the build up, and that's a sign right that, hey, now you can get ready to trade the breakout. So if you look back earlier in time, at this point, I wouldn't be interested, right, to buy the breakout yet at this point. Why is that? Because the 20 MA has not caught up with the price. This tells you that the market still need time, right, to store more potential energy. Okay, so this is what I look for, the 20 MA to catch up with the price. Moving on, the fourth thing. Once you have nailed down 1, 2, and 3, right, number 4 is actually very simple. You can enter using a buy stop order or simply a break and close above the highs. So I'm assuming you understand what this is, right? Placing a buy stop order above resistance or a break and close above the highs. So let me just explain a break and close above the highs. So what you're looking for is simply for the price to break and close above the highs of the build up. So in this case, it's this candle here. Notice this candle has break and close above the highs of this build up. So this is another technique that you can use to time your entry. There is no best approach. There isn't, which one is better, whether it's a buy stop order or whether a break and close. They are fine. So just go with whichever, right, you are more comfortable with. And the fifth thing, right, stop loss and exit, right? Where do you set your stop loss? When do you exit your winning trade? Okay, so let's cover that, right? So for stop loss, right, I like to set it 1 ATR below the low of a build up. Okay, and for exit, you can use a tool like the chandelier, crow stop, moving average, etc. So let me just walk you through these concepts. So for stop loss, right, let's say the market breaks out, right? What I'm going to do is I'm going to pull out the ATR indicator. Okay, I typically use a 20 period ATR because there's 20 trading days in a month. I use SMA just a preference, and what I'm going to do is find out what is the ATR value when I trade when the breakout occurred. So in this case, you can see that it's about 60 pips, right? So this tells you that on New Zealand yen, on a daily basis over the last 20 days, right, this market has moved an average of 60 pips. So what I'll do is I'll find out what is the lows of this build up over here and minus 60 pips. So let's assume, right, that the lows of this build up is $69. Sorry, is it? Yep, $69. I'll just take $69 and I minus 60 pips, right, for this New Zealand yen, and I get about $68.40. So my stop loss, right, will be somewhere around $68.40, somewhere about here. This is my stop loss. So pretty much a 1 ATR below the low of the build up. Does it make sense? Okay, that's my initial stop loss. And as for taking profits, when do you take profits? So again, a very simple way you can use is to use moving average. Depending on the type of trend that you want to capture, you can use a tool like the 50 MA. Okay, so if the price moves in your favor, you exit the trade when the price closes below the 50 MA. So in this case, right, you will exit when the price breaks and closes below the 50 MA over here. Simple stuff. Okay, so you can see that once you kind of understand these concepts, right, these steps 1, 2, 3, 4, and 5, right, you find that your breakout trading is that much improved. So let me walk you through a few examples, right, of the things that we have just discussed. Okay, so New Zealand yen, again, I think I just did this perfect example here. I mean, first and foremost, right, the examples that I'm going to share with you, they are all obviously cherry picked, right? I'm not going to be a moronic guy who cherry pick his charts to prove that my illustrations or my concepts is wrong. So they are cherry picked, right? They are winners, right? But here's the thing: the concepts that I share with you are meant for you to validate and verify it on your own. Don't take what I share with you at face value. That's kind of gambling, right? Take the ideas, the concepts, and verify, to see whether is Rayner telling the truth or is he just a BS fluff guy, right? It's all on you. So first thing first, right? New Zealand yen, right? Again, we are going to measure the range of this market first. So from here to here, at least 80 candles generally. So you can see that over here we have about 70. Okay, from the way I draw it right now, it's about 77, 78, right? Perfectly fine. Okay. Next thing we are looking for is a build up. Number 2, okay, which is here, a build up. Third thing we are looking for is for the 20 MA to catch up with the build up, which it has shown over here, right? Number 4, we can enter using simply a buy stop order or a break and close above the high. So let's say we go with a buy stop order above this highs, okay? And number 5, stop loss and exit, right? So stop loss is just simply 1 ATR below the lows of this build up, okay? And exit could be trailing your stops using the 50 MA. Okay, so let's say price does break out of the highs. Okay, we get long when it breaks above this highs, or if you want to wait for a break and close, it's up to you. And then you trail your stop loss, right, until the price breaks and close below the 50 MA. Okay, so let's move on. Next one. So this one is Bitcoin. Okay, so again, same thing here. Let's say before the breakout, we are looking for the range to be of at least 80 candles. So pull out the range. Let's see how many candles this is from here all the way down to here. We have about 128 bars, clearly meeting our rules. Next thing, we're looking for a build up. Okay, so a build up, right? So over here is the build up, this portion here. Okay, and notice it's kind of like, a series of higher lows approaching resistance. So let's say this is resistance, then this is the series of higher lows approaching resistance. Great, we have a build up over here. Next thing, all right, we want to make sure that the 20 MA has caught up with the build up. So pull out your 20 MA. Nice, right? It has caught up with the build up. So what we're going to do next is just to simply use a very simple entry trigger. Let's say a break above the highs, right? Buy stop order above this highs. You go long, right? And your stop loss is 1 ATR below the lows. So at this point, right, you can see that your swing low would probably be at this lows over here. Or if you're more conservative, you can even set it at this lows. So pull out your ATR indicator. Let me just walk you through quickly. ATR indicator. Okay, again, I'm just going to change this to 20. SMA. Okay. So what we're going to do is to find out what's the current ATR value before it breaks out. Or at the point of breakout, it's fine as well. Okay, so let's say. So at the point of breakout, it's about $144. But actually, you wouldn't do it, right? If you use a buy stop order, you'll place a buy stop order above this highs, for example. Find out what's the ATR value, let's say $75. Then you find out what's the low at this point over here. So let's say the low is X. X minus $75. And let's say that is Y. Okay, so the Y is your stop loss. Very simple math over here, okay? So that's for Bitcoin. So let's move on, right? Let's talk another chart example. So let's say this one again, right? Same concept. Right? I think you're going to get sick of me repeating over and over again. So again, same thing. First thing first, identify the range. How many candles are there? In this case, we have about 84 bars as shown over here, right? 84. So this range has about 84 bars. That's perfectly fine. Next thing we want to do is to identify the build up. So in this case, we have the build up over here at resistance. The third thing is that for the 20 MA to catch up with the build up. So pull out your 20 MA. Nice. It has touched it as well. Next thing we're going to do is entry trigger. It's very simple. Buy stop order above the highs. Fifth thing is stop loss 1 ATR below this low somewhere here. And then if the market moves in your favor, you can trail your stop loss. Let's say, for example, using the 50 MA or even the chandelier crow stop if you want. So if you use the 50 MA, right? So you can see that you can ride this wave up higher as well. Okay. So let's have a look at a few more examples before we conclude today's lesson. Euro dollar. Okay. You know what, let's do one more stock example, Microsoft, right? To share with you that, examples can even be applied to the stock markets. So Microsoft, look for the range on this market. Let's say the range starts from here. Okay, and all the way up here. So this one is a bit short, right? This range. Okay, but still it's about 73 bars. Okay. And again, that's number one. We have the range, close to 80 candles. Next thing, right? Looking for the build up. So at this point, we have this build up over here. But just because it has a build up doesn't mean we want to place a buy stop order immediately. Because if you recall, we want a 20 MA to be our guide, to signal to us that the market is getting ready to make a move. So pull out your 20 MA. Nice, right? It has touched the build up as well. So at this point, once it has touched the build up, you can place a buy stop order above the highs of the build up. Okay, so once you touch it, you can place a buy stop order above the highs of this build up, right? Then stop loss 1 ATR below the low of the build up. You can reference this low, set it 1 ATR below it, and then if the market breaks out higher, you can trail your stop loss, progressively. Again, you can use the 50 MA. That's quite straightforward, 50 MA. Or again, you can use the chandelier crow stop, which is this indicator here. Chandelier stop, right? You can see that it uses volatility in the market to trail your stop loss. Here's how it looks like. It looks like this blue line over here, right? Which is you can use to trail your stop loss. So similar concept to the moving average, but just the way the math, the formula that derives this indicator is slightly different. All right, so yeah, that's pretty much it, right? So one bonus tip that I have for you is this before we go, is that if you trade stocks especially, right, sometimes you have too many breakout trading setups to choose from. So which do you go for? Okay, so my suggestion is to focus on buying the strongest markets. Focus on buying stocks, right, that have appreciated the most in price, right? Because these are the ones, right, that tend to continue to outperform the market. And the way you can rank your stocks is use the 50-week rate of change. So for example, let's say you have like 10 stocks that have a potential breakout trading setup, and you're wondering, man, Rayner, which of these 10 stocks do I buy? I don't have enough capital, right? I can't possibly be buying all 10. Then what you can do is to rank these 10 stocks according to their rate of change, and focus on buying, let's say, maybe the top 3 stocks, right, that have the, the highest ROC value. So let's say, for example, right, Microsoft is one of these candidates, and plus another 9 more stocks. Pull out your indicator called the rate of change, ROC, right? And it's this line below, right? Then you just change this to 50 weeks, right? So this is a daily chart. I need about 250 over here, okay? Okay, so 250. So what this tells you is that, okay, so there might be some confusion. Hey, Rayner, here you put a 50-week ROC, but why this over here you put 250? And the reason is quite simple. From a daily to a weekly, right, you need to multiply it by 5, okay? But if you want to do everything on the daily chart, then just change this to 250, which is in essence, right, a 50-week ROC. So what this tells you is that over the last 250 days on this chart, okay, this market, right, has, or rather this stock, right, has increased 39.68%. Okay, so you have to rank all your 10 stocks, right, according to their, in this case, 250 period ROC. If you are on a daily chart, if you're on a weekly, right, then it will be the 50-week ROC. So you have to rank them according to their rate of change and focus on buying, right, those with the highest ROC values, because this tells you that these are the stocks that have been the strongest over the last 50 weeks, and chances are these are the stocks, right, that are likely to outperform the market in the future as well. Okay, so this is just one tip that I have for you. If you have too many setups to choose, focus on buying the stocks that are the strongest, okay, that have move up the most over the last 50 weeks, for example. So let's do a quick recap, right? So the 5 things to look for before you place a breakout trade. Number 1 is, a range of at least 80 candles or more. If you have a 77.75 candle range, I'm just kidding, right? That doesn't happen, but you get my point, right? Don't be too anal about it. Next thing we are looking for is a build up, because this is a sign of strength. The third thing we want to see is the 20 MA to touch the build up. So it's a signal that the market is getting ready to make a move. Number 4, your entry trigger could be as simple as, a buy stop order or a break and close above the highs. And number 5, setting your stop loss, right, which is a 1 ATR below the low of the build up. And then if the market moves in your favor, you can exit, right, using the 50-day moving average or the 50-period moving average. Simple. Okay, so hopefully, this helps you with your breakout trading. And if you want to learn more about breakout trading, price action trading, then I would suggest, right, you can go down to my website over here, tradingwithrayner.com over here, and just scroll down a little bit. There are a couple of guides or rather 3 guides, right? But for this that is more relevant to you is the ultimate guide to price action trading, as well as the monster guide to candlestick patterns, right? Just download these 2 guides, click this orange button here, and I'll send it to your email address for free. And again, right, this will help you improve your breakout trading, your pullback trading, and your price action trading analysis in the markets, right? So with that said, right, I wish you good luck and good trading. I will talk to you soon.